Now that we have the concept understood, let's go over a simple example of use cases with some real numbers. All right, let's say we're in the market for a new car. The car we want will run us $40,000. The traditional way of purchasing the car is with cash or most likely a car loan. And using a bank or the dealership, we may be paying 5 to maybe 7% interest on the purchase of the car. But let's think about this for a little bit more. If we used an auto loan, we're slowly paying off the car and gaining title to the vehicle, but we trade something huge without realizing it. We traded that $40,000 of interest earning ability and gave it away to the bank. We lost the ability to build on that $40,000. $40,000 isn't working for us anymore. It's effectively gone. Instead, what if we borrowed from our pre-capitalized life insurance policy and then pay ourselves back over time? What's the major difference? So if we borrow the $40,000 from our policy against the cash value and we use that to fund the car purchase, then we can take however long we want to pay our policy back. An important thing to note is that the insurance carrier doesn't care if the loans are outstanding or not, because to the insurance company, they got to pay out that death benefit either way. So if there's a loan out, they'll just deduct the loan amount from the death benefit unless and until it's paid off. In our example, we didn't even pay anything back into the policy for the first year. This is one of the added benefits of borrowing from our policy. We have loan repayment flexibility. Now, besides the flexibility, the other obvious benefit is that our $40,000 is still working for us inside the policy. Because it's a policy loan, that $40,000 is technically from the coffers of the insurance company, and $40,000 of cash value is pledged as collateral. And because our cash value is still safe inside our policy, it's still growing interest for us. Remember, these policies tend to have a 4 to 5% per year tax deferred internal rate of return over a 30-year period. The cash value prior to taking the loan came out to about $165,597. We then borrow our $40,000 and pay our loan back comfortably over a 7-year period. At the end of those 7 years, our cash value accrued to $226,067. This is what we mean by $40,000 is still working for us. Our example showed that we grew an additional $60,000 in cash value during our payback period.